The Pentagon says the war has cost $25 billion so far. But what does that number count? It counts the missiles already fired and the planes already flown and the gear already chewed through. But that's it. That's the whole ledger. Stuff that's already exploded, which means the Pentagon looked at the smoking crater in the global economy and said, there's nothing to see here except the cost of the bomb that caused that crater. Look, the number the Pentagon gave is precise. It's official. But it's almost completely beside the point. It's a tidy answer to a tiny question dressed up as the big one. They're answering the question, what's the price tag on the bombs we've already exploded? But the question that real people care about is broader and more important. It's, what does this war cost us? How are our lives different? What future did we have last year that we don't have now? I just wrote an op-ed on this for the New York Times. In that piece, which I'll link in the comments, I make the case that the Pentagon has dramatically understated the cost of war. The true cost is not tens of billions of dollars, it's hundreds of billions and maybe trillions. The cost of your family is thousands of dollars or perhaps tens of thousands. Honestly, I'm pretty proud of this analysis because we're entering a virtual void of informed discussion. The Pentagon puts out nonsense, Wall Street runs numbers and quietly emails them to clients, and the government analyses, which I hope exist, well, they're kept secret from the taxpayers who paid for them. So you and I, the broader public, don't see any of this. So I'm here to work through the numbers in the open with you. This video is the director's cut, not because economic analyses need to be more drawn out, but rather to show you how we economists do our work when the question is big and messy and unfamiliar, because those tend to be the most important question. The central idea behind everything I'm going to show you is pretty simple, and that brings us to our first big idea for today. It's an idea that economists have a name for. We call it opportunity cost. The cost of any choice isn't just what you pay for it in money, it's what you give up by choosing it. Opportunity cost means comparing the world you have to the world you might have had. The real cost of war isn't just what exploded, it's the future we don't get. Okay, sit with that for a second. Opportunity cost asks a baseline question. Compared to a world where we hadn't gone to war, what's different now? That difference, that's the cost. The cost of war is measured in foregone possibilities, output that we don't produce, jobs that are destroyed and jobs that aren't created. It's investment that doesn't take place. It's future budgets that are going to be committed elsewhere to defense spending, living standards that are lower than they would otherwise have been, and possibilities, personal possibilities, national possibilities, geopolitical possibilities that are now gone. That's a much broader and more economically coherent way to think about cost than just adding up the dollars already spent. And that's why the Pentagon's $25 billion is so grotesquely misleading, not because it's made up, but because it answers a narrow and fairly uninteresting question while sounding like it's answering the big one. Look, here's an insight I've learned from years of economisting. Every number answers a question. But one of the most important habits you can develop is to stop and ask, is this number answering the question I actually care about? Often the answer isn't wrong, and in the narrow sense, Hegseth's $25 billion isn't wrong, but it's the right answer to the wrong question. Okay, our second big set of ideas to think about is the role that oil plays in the economy. After all, whenever you're thinking about the broader costs of war in the Middle East, honestly, this is the natural starting point. And it matters because oil sits upstream of just about everything. It powers transport, it moves through shipping, it hits aviation and logistics and chemicals and plastics. It feeds into food costs and delivery costs and production costs. When oil prices rise and stay high, that ripples through the whole economy. Oil is where geopolitics turns into economics. A war in the Gulf isn't just a foreign policy event. It's a shock to one of the most important input prices on the planet. In the New York Times piece, I point out that oil futures for the end of 2026, 2027, and 2028 are all still sitting above where they were before the war. In fact, over the past week or so, they've hit record highs, which tells you something about how the war's going. Point is, markets aren't treating this as a short-term scare. They're pricing in a more expensive energy world that'll stick around for years. That means that the same workers, the same machines, and the same effort produces less real value than they otherwise would. The economy's productive possibilities shift down. Now, let's start building a real number estimate of the cost of all of this, which is why I want to introduce you to the third big actor in this play. It's the Fed. Hey, Jay. Before the war, markets are expecting 2 rate cuts this year, each of a quarter point. Since the war, Fed funds futures have shifted to pricing in no rate cuts. So the expected path of interest rates is now about half a percentage point higher than markets had penciled in just before the war. That means war didn't just raise oil prices, it also changed the expected future path of monetary policy. Higher oil prices means inflation pressure. That gives the Fed less room to cut. It's particularly worrying at a moment when inflation has been above the Fed's inflation target for years. Ordinarily, the Fed might try to look through that or ignore an oil-driven supply shock. But this time it's worried that this could cause inflation expectations to rise. That's why Jay Powell's got that grey hair. So the Fed has abandoned the idea of cutting rates this year. And when markets go from expecting rate cuts to expecting none, the tighter expected path is itself a drag on economic growth. Now, here's the rough arithmetic. The Fed has a gigantic macroeconometric model called FRBUS, FURBUS to its friends, and it uses it to forecast the economy. It's especially useful for things like figuring out what happens to output after a rise in rates. We can actually look it up on the Fed's website to see the effects that FURBUS expects to see on the economy. So we have to scale this picture so it's the right one for rates rising by half a percentage point, and we add up the effects quarter by quarter on the output gap, and this gets you to a sum total of about 0.625% of GDP. In a $31 trillion economy, that's about $193 billion. Hey, let's just call that $200 billion, okay? That's the kind of back of the envelope arithmetic that economists do all the time. Not because I think this model or this exercise gives you the one true number, but because I'm trying to get a sense of the orders of magnitude here. And so that brings us to the fourth big idea, which is to look at geopolitical risk, which is itself an economic factor. Two Fed economists, Dario Caldara and Matteo Iacovello, whose name I surely just butchered, they built something called the Geopolitical Risk Index. This basically measures how much geopolitical fear and instability is in the air. Since the war began, that index has gone from about 150 to about 250. Now, here's how that becomes an economic estimate. First, I worked out how big of a shock that is in the language of their paper. So it comes out to be roughly a 2 standard deviation shock. If you remember your statistics, they're pretty unusual. Second, the appendix to their paper shows what a 2 standard deviation shock to geopolitical risk does to GDP over time. And then I just added up those GDP effects quarter by quarter. And when you do that, you get a total loss of about 0.6% of GDP, which doesn't sound like much until I remind you, in an economy of our size, that's about $200 billion. Fun thing to note here, different method, same number of zeros. We're now on to idea number 5, which is to see what markets are telling us. This might be the most provocative estimate of the lot. Over weeks and months, stock prices move for all sorts of reasons. There's earnings news, there's AI mania, inflation data, consumer spending. A possum sneezes in Palo Alto and Nvidia stock moves up 4%. So if you want to isolate the part of the stock market that's about the war, you need some kind of index of war news, how it's going, the intensity of it all. Look, I don't have a perfect index, but I do have a pretty good proxy. Let's track daily movements in oil prices. Why? Because when the war news has gotten worse, oil prices have tended to rise. Oil has basically become a running scorecard of how bad markets think the war news is on any given day. So then I just asked a simple question. On days when oil rises, suggesting the war's going poorly, what happens to stocks? I regressed daily percentage changes in the S&P 500 on daily percentage changes in West Texas Intermediate, my favorite flavor of oil, and I discovered the slope is about 0.09. Let me say that in English. A 10% rise in oil is associated with about a 0.9% fall in the S&P 500. Now zoom out. Oil rose from roughly $65 before the war to roughly $110 after. That's nearly a 70% jump. Apply that rough relationship, and that means you get a rough implication. 70% change in oil prices times zero point 0.9 means that stock values are about 6% lower than they would otherwise have been. I'll round down to 5% to be conservative and keep it a nice round number. And if the S&P is worth about $60 trillion, then losing 5% off the value of the S&P means we lost about $3 trillion of value for American corporations. Hey, look, I want to be clear about what sort of estimate this is. It's a provocative, rough cut. But that's all it is. Even so, it's useful because it captures something important. Financial markets seem to think the future path of profits for American companies is materially, more than material, a lot worse because of this war. Hey, there's one more way to get at this, and that brings us to our sixth idea. Instead of building one mechanism at a time, we can look at professional forecasters who are trying to integrate many effects at once. Look, I get to see what Wall Street economists are saying, and I'm going to share it with you. Goldman Sachs cut its 2026 GDP growth forecast by 0.5 percentage point because of the Iran war. First, they cut it by less, but then things didn't go so well. What matters here isn't just the growth rate headline, it's what it means for the level of GDP and for how long GDP remains lower than it would otherwise have been. If the economy grows more slowly for a while and only gradually claws back to its old path, then the missing output during that transition is gone. You don't just magically make it up later. So I translated Goldman's growth downgrade into the implied path of GDP levels over time and compared that to what they reckoned would have happened with no war, and I added up all the output we never produce. And that gets you to roughly $400 billion. Now, is that independent of the Fed estimate, the oil estimate, and the geopolitical risk estimate? Probably not entirely. Wall Street economists are trying to account for each of those factors. The point of looking at this problem, though, from many different angles isn't to stack them up like poker chips. The point is that a whole bunch of different approaches are landing in the same broad territory. They're telling you the stakes here should be thought of as in terms of hundreds of billions of dollars, possibly much more. And that gets us to the seventh big idea. What does this mean in the longer run? Wars change the strategic environment. If Iran is now seen as a bigger long-run threat, or if the region becomes more dangerous, or if our alliances have become frayed, then policymakers will argue that maintaining US military supremacy now costs more. Or if others spend more on the military, we'll have to spend more to keep up. It's an arms race, and nobody wins except defense companies who get rich. How big are these numbers? Look, I'm just going to tell you, I don't know. So I figured we could go to the White House to find out. Hey, come with me. The White House requested a defense budget of $1.5 trillion for the 2027 fiscal year. That's about a $600 billion increase. Now, there's roughly 130 million households in America, so that's about $4,000 a year that your family's being asked to chip in extra defense spending. Here's the thing, that's only the number for 2027. The White House has been very loud about next year's increase and very quiet about what it expects in 2028 and 2029 and all the years after that. History gives you a pretty clear hint, though. Defense build-ups have a habit of sticking around. The contractors get organized, the bases get their own zip codes, the supply chains acquire political constituencies, and what was sold as an emergency response suspiciously quickly starts to transform into the new normal. So if the past is any guide, a $600 billion rise in defense spending just for next year could easily pencil out to $3 or $4 trillion more in defense spending over the next decade. That's money we won't use to build roads or hospitals or to help people get health insurance or a million other ways we can live richer, fuller lives. Saying it this way makes it clear that this is not a side issue. It's a big part of the cost of war because war doesn't just consume resources in the moment. It also locks in a more expensive future. That brings us to our eighth big idea, and I never thought I'd come to explain this to you. It's incredibly important, but it sounds incredibly dull. It's cash flow accounting versus accrual accounting. I know your eyes are glazing over, mine too, and I love this stuff. But for war, this distinction is absolutely central because war is one of those choices where a huge share of the costs show up later. Cash flow accounting asks what money has gone out the door so far. That's basically what the Pentagon's $25 billion is doing. It counts the missiles already fired, the planes already flown, the equipment already lost, and that's it. Accrual accounting asks the deeper and more important question. What costs, losses, and obligations has this decision, the decision to go to war, created? We care about all of those costs, whenever it is that their bills arrive. That's the economically serious question. This is where perhaps maybe a few analogies will help. You can't say the cost of a puppy is $200 because that was the adoption fee. Mate, my good dog Max, he also eats, he gets expensive vet care, and he demands lots of toys. You can't say a house only costs the down payment. The mortgage still exists and you're paying big amounts every month for 30 years. And just like that, you can't say a war costs only the missiles already fired. Wars also create future obligations. Veterans' medical care, disability payments. Look, a bloody conflict makes it harder to recruit soldiers, and this shows up as higher recruitment and retention costs in the future. And then you compound all of these costs with the interest bill on the money borrowed to pay for it all. Linda Bilmes and Joe Stiglitz made this point powerfully back during the Iraq War. Note the cue, I'm talking about a previous war, Iraq. Their estimate of the Iraq War's true cost ran to around $3 trillion. And a huge share of that arrived after the main fighting because the obligations created by war kept generating bills for years. That's the deeper logic here. The Pentagon's giving you the sticker price. I'm trying to estimate the total cost of ownership. And if the Iraq War teaches us anything, it's that the costs run to trillions of dollars, and these costs are paid out over decades. Let me try to wrap this up and make sense of it all with a somewhat broader economics lesson. Artificial precision, it's the easiest way to make an economic number go viral. And the Pentagon's $25 billion has gotten far more attention than it deserves. A tidy number beats a messy one almost every time when it comes to the media. Politicians know this. They're counting on it. My approach is different. I'm not trying to give you an exact answer that's probably wrong. I'm trying to think like an economist where the question is big, messy, and unfamiliar. Start with the right baseline. Compare the world we have to the world we might have had. Follow the clues through oil, interest rates, market prices, growth forecasts, and future budgets. And above all, try to figure out the right number of zeros. That's more important than any minor detail. When I do that here, the answer isn't subtle. The war isn't costing America $25 billion. It's costing hundreds of billions of dollars and quite possibly trillions. We'd be a country that's poorer, more constrained, and living with a worse set of possibilities than those we had before this war began. And that's the final lesson. Look, every number answers a question. The trick is to ask whether it answers the question you actually care about, or whether a politician has instead handed you a neat little number so precise you won't notice. My analysis echoes both common sense and many historical lessons. War is hell, and hell comes with a hefty price tag.